What's going on, guys? My name is Eldon Lee. I'm a FX trader, uni student as well. Anyways, basically, this video is just to show you guys how to actually track your trading data meaningfully, as well as have actionable steps in terms of, how to improve on your trading, because everybody has a strategy, everybody knows how to trade, everybody has psychology, yada yada yada. But I think the true key to having a profitable edge is not just, you know, seeing your own trades or journaling screenshots and stuff like that, but you actually got to look at the data and you got to analyze critically, quantitatively, what works and what doesn't work, right? And so in this video, it's going to be a one take video. It's my first video, so I don't really expect much, but I just hope to bring you guys some value in terms of how to improve in your trading, what to look out for in your trading, as well as, some tips and tricks here and there, right? Um, I'm no, by any means a successful, massively successful, profitable trader, but you know, for the past few years, I've been working towards you know, a funded account, trying to get profitable, trying to scale, and right now I have a 100K funded account. Through proper risk management, I've never blown a funded account, since last year or the past 2 years. I mean, basically this year, right? So for the whole of 2025, I've not blown a funded account, and in fact I've got a funded 100K, and coming 2026 the goal is to get 500K funded. So yeah, right. So that's pretty much it, and you can see on the chart right here, this is my equity curve, um, based off of my phase 1, phase 2 and funded account. Unfortunately, I didn't get a payout yet with this 100K funded, because after I got funded the 100K, I immediately went into drawdown, as you can see here. But I managed to recover and slowly coming back to break even. So yeah, anyways, um, so this is my spreadsheet, right? And so what I have here on the left is basically a list of my core metrics, because it's important to have a an overview of how well your edge or your strategy is doing, right? So before all of this, you can see on my raw trades here, I've documented every single trade that I took this year, right, through my accounts. So spanning from March, I only started trading in March this year, all the way until December, right, as you can see. And I only trade euro and gold, right? So I only trade euro and gold, and I document the direction, the R multiple, the dollar profit loss, the percentage return off of the 100K, the day of the week, as well as the PNL, right, the running equity curve, as you can see here. And then I also documented my daily returns. So this is basically, um, showing each day's PNL, right? So every day's PNL, and then the returns as well, the running equity, and I also did some other metrics like the drawdown, the rolling 20-day volatility, the rolling 20-day sharp, as well as calculating other metrics. But besides that, right, I think it's important when you are tracking your live data to have some sort of metrics, so you can see how well are you actually performing compared to, you know, investing or normal traders or hedge funds or whatever, right? So if you look at the left hand corner here, you can see that I've calculated what my compounded annual growth, my Sharp, my Sortino, my max drawdown, what's my win rate, what's my expectancy per trade, what is my payoff ratio or my average risk to reward ratio, and my cumulative return, right? So you can see, the numbers are there. To me, I feel that my numbers are okay, right? Because for most prop firms, you have a strict max drawdown of 10%. Unfortunately, there is a 10.12%, but I didn't actually blow anything. I didn't, this was just me going into drawdown from my peak, right? I was up, I think, about 8% here, and then I went into a 10.12% drawdown to 96, but I didn't break the 10% drawdown rule, and then I recovered all of that, passed phase one, passed phase two, got funded, and then went into another deep drawdown again, which is normal, right? Because every trading system will run into a series of drawdowns, and the important part is how you recover from it, lah. You know. So I've been doing that pretty well. I halved my risk. I lowered my trade frequency. Slowly try to recover, and I recovered a substantial 4% here. And mind you, I was risking 0.25%, so that is basically what 16 risk reward, right? To slowly recover, and yeah, you just gotta be patient. And so, yeah, even though I have a low hit rate, right, a low win rate of 30%, but because of my risk reward of an average of 2.72, but most of my winners are, you know, 3, 4, 5, 6 risk reward, right? So later we can get into that. But it's also important to look at your risk metrics, right, to see how well can you survive a drawdown. So you can see my daily volatility is actually 1.16%, which means on any given day, right, whether I win or lose, it's about 1.16%, which is not too bad, right? Because you don't want your account to be moving 2-3% every single day, right? You'll be blowing accounts very fast, right? And then my annualized volatility is 18%. My VAR, rolling 20-day volatility, is all within acceptable ranges, right? This is just to show that I have significant downside containment, right? I'm very good at controlling my drawdown and not letting it get out of control, downsizing my risk, reducing my trade frequency, just to survive, right? Because at the end of the day, trading is for you to survive, right? You want to survive in the long run. That's how you show and prove to yourself to be consistently profitable. There's no point being profitable for 2-3 months and then the next few months you're just so down, so losing streak after losing streak, blowing accounts. It reduces your confidence, right? You want to have confidence in your edge, and to do that you need to be able to survive drawdowns, and to do that you have to be able to have good risk management, right? Lower your risk. And so you can see for the year I've had 116, sorry, let me just zoom this in so you can see. I've had 116 drawdown days, right? For the whole year, I think it's like what, 250 trading days? I'm not sure, but 116 of them were in drawdown, or basically losing days, right? And it took me an average of 21 days to recover, to get past my drawdown. And it's nice to know that my risk of ruin is basically zero, which means the probability of me actually losing my entire account is zero, which of course makes sense lah, because I'm playing with a 10% drawdown. But we can also take a look at my Monte Carlo simulation. So I basically did a simulation on Python, basically to show what is the probability of me blowing that 10% drawdown, right? And you can see here it comes out to be 5.3%, right? But it also depends on your risk. So if I'm risking 1% per trade, right, my probability of losing 10% is 15%, and the probability if I risk 0.5%, it's lesser, and it gets significantly lesser, right? With just 0.5% of 0.5% probability of losing my account if I risk 0.25%. So this gives me some comfort, right, knowing that my risk management is solid, right? The probability of me blowing account is very low, in fact near zero, right? But that's just only one part, right? You also need to be able to have profitable trades to pass to get a payout. So it comes hand in hand, right? There's two pieces that come together, right? One is your risk management and one is the trades that you take. But for me personally, one thing I realized is that I can always take profitable trades. I'm always taking profitable trades. All the profitable trades that come from my edge, my strategy, I take them. No problem, right? But the problem is how you reduce your losers. Because my win rate is 30%, right? That means I'm losing 7 out of 10 trades on average. But it's how you reduce that, right? So my progress, my goals is to just reduce the frequency of losing trades, continue taking my winning trades, and eventually the results will show, right? That is how you operate as a trader. That is how you get better, you learn, and you refine your strategy, right? So yeah, my mean equity is about 8-9%, right? Very good. You can see it's skewed towards positively, right? Below the drawdown, below 100,000 is, you know, much lesser, right? Probability. So yeah, then looking at so yeah, I mean, all these are just more quantitative analytics, quantitative metrics. It just gives me more, a clearer picture of what's going on, how I'm trading my strategy. So we have the blah, 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 the Kelly criterion, right, which basically shows what percentage can you risk per trade that can confidently not blow your account, right? So the full Kelly is 4.93% or 5%, which in theory means I can risk 5%, no problem per trade. I won't blow my account. But that obviously means, if it's a full account, your live account, you can risk 5%, no problem. But with a funded account, you only have 10% drawdown, so you can't do that. And so most traders don't really look at the full Kelly. They look at the half or the quarter Kelly. So the quarter Kelly is quite significant because with a 1.23% risk per trade, I can comfortably risk that amount and I won't blow my account, right? But for me, I stick to 0.5% first because, you have to work around the 10% maximum drawdown, right? So, I mean, the lower that I can get these numbers, the more confident I can be, right? Knowing that my strategy is profitable, it can survive drawdown, and I won't blow my account, right? This is more towards like, when you have a live account, then it will be more useful. And then in terms of skewness and kurtosis, it's basically showing the distribution of my wins and losses, right? And you can see my daily returns. Most of my winners are fat-tailed, in a sense that it's way bigger than my losses. You can see that my losses here are very well controlled, except for, some times that I got slipped out because of slippage and news. But in general, my losses are kept at 0.5%, very strict. And then my winners are the, 2%, 3% winners, right? So the risk reward of about 4 to 6 around there. So that is how, my strategy is lah. Because for some people it might be different. Some people it might be, they have like a 1-to-1, 1-to-1.5 risk reward. So their skewness in terms of the wins and losses is not that high. But for my strategy, it's very different. So yeah, and so my performance for the year is not the best, but I won't say it's not the worst, right? I guess you can consider me to still be somewhat breaking even, right? Even though I'm up 10% on the year, but you can see that based on this chart here, right? I was up 1-2% for March and April, right? May to June, some drawdown, July, and then August, I had a spectacular month. I was up 30 risk reward, right? I was risking 0.5% and I was up 15%. So that's about 30 risk reward. And then come September, got my funded account, started going to deep drawdown. And then October, November, December is just me slowly recovering with that reduced risk. Because if I was still risking 0.5% here, I would have probably lost my account, right? But because I was lowering my risk, trying to reduce my frequency, slowly recover. So which is why October and November was pretty much break even, and December was, up 3%. So as you can see here, right? So yeah, that is kind of my performance. This is my quarterly performance, right? 1% Q1, minus 2.85%, 9.69% in Q3, and 2.68 in Q4. Now you might be thinking like, bro, these returns are ass, bro. Like, say real. I mean, like, of course, yeah, this is me trading with, hard rules, 10% drawdown, and I have to work around with 0.5% risk per trade. I went into drawdown, so I had to reduce to 0.25%, not to blow the account. And, like, you might be asking, what's the point, right? Like, I mean, if you blow the account, then just get another one and then just trade again, lah. But then it kind of defeats the purpose of the whole idea of getting a funded account, right? Because the funded account is supposed to be, it's supposed to teach you proper risk management, not some bullshit like full potting or risking 1-2% per trade, passing it in 1 or 2 trades. Yeah, you can get a payout. Yeah, you can be profitable, but it doesn't prove anything of being consistently profitable. It doesn't show you that. I mean, it to me, it's psychology worse because it's giving you money, right? You get a payout, you pass within a few days, but it's rewarding you for being lucky. You know what I mean? It's rewarding you for being lucky. It's not rewarding you for being a consistently profitable trader. There's a reason why there's a 10%, you know, 10% to pass phase one, 5% to pass phase two, and then you get a payout. It's to prove that you are consistently profitable, right? And yeah, you can consider the opportunity cost, the time taken to pass and get a funded account. But at the end of the day, what is trading for? Is trading just for you to get rich quick? Is it just for you to make money, get the fuck out? Or are you in it for the long game? Are you in it for the lifetime of freedom, of financial freedom, time freedom, geographical freedom? It's difficult. It's not supposed to be boom, quick pass, payout, boom, 20K, boom, live life. No. It's about being consistently profitable and then scaling, and then you will see the long term results, right? We're talking about 10K months, 20K months, consistently, month after month after month, with a 500K funding, 1 mil funded account, right, in total. So, yeah, this is just my thoughts. It's just my opinion. I take it with a grain of salt. I'm not like a mentor, a successful trader, a millionaire, but it's just what I've learned over the years of trading, right? It's something that you need to be in the long game. You need to survive it. You need to survive the periods of losses and drawdown and learning and recovering. That's how you grow, right? You don't grow as a trader. You don't get better as a trader by being lucky and making all this money from getting payouts in 2-3 days. No, you become a better trader by learning more about your strategy, about your edge, about how you behave as a trader, how you think as a trader, and can it be sustainable, right? Trading is a long game, 100%. So yeah, that is my performance for the year. And as you can see, right, after creating, the data that you have, oh yeah, so for this spreadsheet, I didn't include the duration, but I went to create another spreadsheet and basically input the open closing time as well as the duration, just to get a better view of how my trades actually perform based on the sessions, based on the hour. And it it will help a lot lah, because it will show you which time of the day are you the most profitable. Because if you're profitable, if you're the most profitable in the New York session from 9 p.m. onwards, why are you trading London session, right? If you're most profitable trading London session, why are you trading New York? You're just exposing yourself unnecessarily to more losses, right? So I'll show you in a bit how it works. So just to break it down, as you can see, in terms of my trading performance, between the pairs, right, between euro and gold, long versus short, right, I'm most profitable taking longs, right? You can see that taking shorts on both euro and gold are unprofitable for me. So, I mean, I don't have to necessarily follow it. I mean, I do follow it for gold because if you look at gold's price action, there is literally no point shorting it, right? You can see the price action for the whole year. It's been pretty much bullish for the whole year, and shorting it is kind of stupid. So I don't short gold at all. Now lah, I mean, back when I was still, trying to pass and stuff, like I was still taking shots on gold and it was losing, so there's no point. So, this data shows and tells me that, bro, just trade longs on both your euro and gold. Don't trade shorts because you're unprofitable on shorts, right? That is your edge telling you to take longs over shorts, right? And you can do this by, tracking the data and then creating pivot tables on Excel. If you don't know, go and ask ChatGPT or YouTube how to do it, but it will show you right here, right? And then I can even break it down even more and see what days of the week am I profitable, right? And you can see Mondays are the worst for me to trade euro. So ever since, I don't know, the mid of the year, or yeah, pretty much, I think if I'm not wrong, I stopped trading um, euro on Mondays because it's just so unprofitable. It doesn't, like, the entry criteria are there, right, for me to enter the trade, but it just doesn't work. So you just have to learn, right, okay, from the data, and just stop trading on Monday. So that's what I do. So you can see on pretty much on my raw trades here, right, you can see that I very rarely trade Mondays. Yeah, like only time I trade Monday is on gold, right? The last times I trade Monday is on gold, or this euro on in September. But yeah, that was a mistake, right? I shouldn't have traded. So it's all about learning and seeing the data and how you can basically adjust your trading behaviors, your trading patterns to what is the most profitable for your strategy, right? So on euro, right, my most profitable trading days are Wednesday, Thursday, and Friday, right, which is news, right? NFP, unemployment claims, your GDP news that comes out every quarter, your JOLTS job openings, your CPI, your PPI. It all comes out on Wednesday, Thursday, Friday, and that's where the volatility is, and that's when my strategy or my edge comes out, right? So, right, with this piece of information, I can very simply don't trade on Monday, don't trade on Tuesday, just look at the charts on Wednesday, Thursday, Friday, and be 100% focused and make the decision to trade, right? And then similarly for gold, right, the first 3 days, Monday, Tuesday, Wednesday, is unprofitable for me, so I just don't trade. And you can see on Wednesday is the most unprofitable for me, right? Which kind of makes sense because if you look at gold's weekly price action, right, usually Wednesday is when price dips and sweeps. So you can see here Wednesday, this was also on Wednesday. You can see the dips are usually on Wednesday, right? And those are the times when I actually get taken out of the trade because it went for a deeper mitigation. So that's just something for me to learn, right? So okay, Wednesdays don't trade gold, leave it to Thursday and Friday, right, where I'm the most profitable. So this is how you kind of like, sorry, this is how important it is to have data, because with the data you can see which days you are most profitable, and then just avoid the days you're unprofitable. By default, you're already eliminating unnecessary losses. You know what I mean? And then you can say like, bro, but I mean, what if there's a good setup on this day? On this day? Sure, if you want to take it, right? But make sure you track it down, right? Put it in your data, and for you to analyze and see truly whether is it worth taking the risk trading on those days, right? Like for me, I just completely eliminate Mondays because it's so ass. And then for gold, maybe I will just risk it like lesser or half my risk trading Wednesday, or maybe even coming next year I won't trade it at all, right? If it's truly unprofitable. But of course, I can't just rely on 1 year worth of data. So it's why important for me to continue to trade, to live test and track it to make sure that, okay, Wednesday truly is unprofitable for me, right? I don't even have to trade on Wednesday. I can just, record it down, as a, live test, not actually executing on the trade on Wednesday, but actually seeing, okay, there's this opportunity to trade. It's Wednesday. I'm not going to take the trade, but I'm just going to, put the entry, stop loss, take profit, and then record it down. And then you see, right? So Thursday, Friday, profitable for me on gold. So that is another piece of useful information, right, of tracking. So you can see in terms of the number of trades that I took this year so far is almost 200 trades, which means, if I'm not wrong, it's like about 1.4 or 5 trades per trading day. And then I've had 60 winning trades, which gives me about 30% hit rate. And my average winning trade is more than my average losing trade, right? And then my payoff ratio, or my risk reward ratio, is 2.72, which is positive, and it's been keeping me positive, as you can see. So yeah. And what I also did was to actually track the session and the hour. And you might be thinking how to do that, right? So of course, first you can simply just, literally key in the open and closing time, and then you can also track the duration. But what you can also do is to basically, so I have the opening time here of every single trade that I took, and what I did was basically use a formula to tell me what hour of the day was it. So you can see 6 p.m. is 18, right? 1800 hours. And then, 4 p.m. is 1600 hours. And then that corresponds to a certain session. So you can see there's this formula here that I used to basically tell me what session of the day was it. Now, the way I look at sessions is a bit different, because my strategy revolves around quarterly theory, right? It's more of a, there's just 4 sessions in the day, and it's split out evenly, right? So from 6 a.m. to, okay, now it's daylight savings time. So from 7 p.m. to 1 p.m. it's Asian for me. Then 1 p.m. to 7 p.m. is London. 7 to 1 a.m. is New York AM session, and then after that is New York PM session. Just to have that, quarterly structure to it. I mean, technically, London Open is at 4 p.m., New York Open is at 9:30, but just based on how I operate, I just fixate it as, okay, London, Asia, New York is in this, 6-hour cycles. So with this, I can do another pivot table and tell me which session am I profitable for which pair. So you can see here, right, on this table here, I'm actually the most profitable in New York, which is actually interesting and crazy to me, because I trade power of 3, right? Accumulation, manipulation, distribution. And Asia session being the accumulation, London being the manipulation, and New York being the distribution. And in my experience, I always catch the entries during the manipulation phase, right? So after it takes out the Asian low, creates a 5 or 15 minute market structure shift, and then I enter at the 0.618 retracement. And that usually happens during the later period of London, so it's around like 6 p.m., 7 p.m., or before 7 p.m., around there. But, based on my data, it seems that my most profitable session is actually New York. So it's actually when I take trades after 7 p.m. So, this is useful information, right? Because I can just simply avoid trading London session, or at least not force trades, subconsciously force trades, right, during London session. I'll just tell myself that, okay, based on my data for 2025, 200 trades taken, I'm most profitable trading New York. So focus on trading New York. It's simple, right? Right here. I pasted it on this spreadsheet. My most profitable session on Euro is actually New York. And for gold, it's actually London. So, okay, I can move forward as a trader, improve, refine my strategy as a trader by only trading London during gold, during London, and trading New York, trading Euro during New York session. That is how I avoid the unnecessary losses, right? So, yeah, this is also why it's important to, okay, I'm an intraday trader, so that's why the sessions are important. Maybe it might not be important if you're a swing trader or whatever position trader, high time frame trader. But for me, as an intraday trader, I have to look at which sessions am I the most profitable, which day of the week am I the most profitable, and maybe even look at which week of the month I'm the most profitable. which I actually haven't done that yet. But yeah. And then, if you break it down the sessions even further, I can see exactly which hour of my trades are the most profitable. So this table here that I created basically shows the hour of entry. So if I look at my other spreadsheet here, right, I only recorded the opening time because I want to know which hour is the most profitable for me to enter the trade. So for example, if I'm very unprofitable, as you can see on this table here, right, I'm very unprofitable trading at 3 p.m., right? So if I see an opportunity on Euro and it's around 3 p.m., right, like price is coming into my entry at 3 p.m., I will think twice. Maybe I just don't trade. Maybe I look, from another perspective, right? Why would this trade go against me? And then I weigh the pros and the cons, right? If at the exact moment and I see that, hey, there are certain criterias or certain, you know, certain criterias that is showing that this is not gonna work. This is gonna be a low probability trade. Then I just don't trade, right? Unless it's really an A plus setup, I risk half. Simple. That's how you adapt to your trading edge, right? So you can see that my most profitable hours of Euro are actually from 7 to 9 p.m., which is around New York's time, right? New York session, right? You can see it's a one cluster of profitable cumulative P&L that's profitable. I mean, sorry, the most profitable time for me to trade, right, given this cumulative P&L, is from 7 to 9 p.m., right? And for gold, it's around 2 to 4 p.m., which is London session, which perfectly corresponds to this data right here, which is telling me that I should trade Euro during New York and trade gold during London, right? It's as simple as that. And then you also can look, okay, which hours am I the most unprofitable? Which hour of the day where I take an entry and I lose the most? And you can see on Euro, it's at 3 p.m. And for gold, for me, it's at, between, right, midnight or even the Asian session or like the early morning, right, for me, right, from 2 a.m. to 9 a.m. or 1 p.m. or basically New York session onwards, right, from 5 p.m. onwards. Taking longs on the gold is not profitable for me. So I should just focus on taking gold trades in the afternoon and Euro trades at night. That is how I continue to take my winning trades and avoid my losing trades. Right? So yeah, this might be very, I don't know, maybe it might bore you, right, to track all of these trades, right, manually entering every single time, right, entering the sessions and the duration, calculating, but you have to do it. That's how you refine your strategy. You don't refine your strategy by adding another indicator, by adding another moving average or adding another fuck, right? It's about looking at your trading data, finding out what has been working, what hasn't been working, and then just focus on the profitable, like the profitable criterias, right? The profitable trades, right? And it's clearly showing me that my profitable times to trade, right? Or my profitable direction to trade. I should just trade longs. I should just trade towards the end of the week, right? Wednesday, Thursday, Friday. And I should just trade New York, Euro, gold, London. That's it. And I'll be way more profitable because I'll be avoiding all those losing opportunities, all those losing low probability time and direction and everything else, right? And it's almost a certainty that you'll avoid taking losing trades naturally, you know, in the long run, and you'll take more of your winning trades in the long run. And that's how you'll be consistently profitable, right? So yeah, you can see you know, I did some other charts, right, showing the, you know, my 10 best trades, my 10 best trades here and my 10 worst trades, which basically shows that I have a good risk reward. Because if it's symmetrical in the middle, right, it will tell me that I'm not trading properly. My risk reward is nearly like 1 to 1. That means like for every winner, it's almost equal to every loser that I have. So it's like not giving me a buffer for me to trade, right? With this, I'm knowing that my trades have an asymmetric payoff, right? My risk reward is about, 2 to 3 risk reward, and for every win, it will cover some losses. And that's how you consistently scale and become profitable, right? You can even see the day of the week, right? Just now from that pivot table, you can see I'm profitable Wednesday, Thursday, Friday. I'm profitable Thursday, Friday on gold, and then I'm unprofitable at the start of the week. So just don't trade at the start of the week, right? And yeah, you can see here, this is my P&L by the hour. And you can see that so blue is euro, yellow is gold. So my most profitable trades come at the later hours of the day during the New York session. And for gold, they come in at the middle of the day, right? In the afternoon, 2 to 6 p.m. So I just need to avoid those other hours to trade, and I will, automatically avoid my losses, start avoiding losing trades, right? Or avoid low probability trades. That is the whole idea. That is the whole point of progressing, learning more about your edge, learning more about how you trade, and improving. It's just like the gym, right? Finding out what your weaknesses are, when it comes to squatting, comes to the deadlift, comes to the bench. Where are your weak points? Which part of the lift are you weakest? Focus on that, you get stronger, and overall your lifts will get better, right? So for example, when I was progressing on my squat, I'm very weak at the bottom, right? When I squat and I go all the way at my lowest, I'm the weakest at the bottom. I can't get out of the hole. So what did I do? I start working on my ass. My glutes, right? Hip thrusts, the RDLs, the back extensions, if you know what that is. And then slowly I build up my core and build up my glutes, and then I started seeing my squat improving. Same with my deadlift, right? I was naturally a very quad heavy lifter, right? My glutes were always weak. So when I deadlift, it was pretty much just all quads, no glutes, and all back, which led to, of course, getting injured twice, right? I injured my back twice already. But, it's from looking at what your weaknesses are, improving on it, getting stronger, getting better. That is how you progress. You can't progress linearly. You have to see your drawdown. You have to see your weaknesses. Where are you weakest at? Where are you losing the most? That is when you improve. Because if you're always winning, if you're always somehow getting stronger without any weaknesses, are you truly learning? Are you truly getting better? Because that's just the results. You know what I mean? I apologize for deviating so much, but I'm trying to give you an example, right? And so, yeah. And in terms of, when you want to create your own data for you to track, it's important that you be very rigorous, very detailed in tracking your data. Because the mistake that I made this year tracking my data was that I didn't include the time. I didn't include the lot size that I used. I didn't include the exact dollar risk that I used, right? Because you can see here that all these R multiples that I calculated was off a fixed $500 risk, or 0.5% per risk, which is true in theory. I did intend to risk 0.5%, but because of, the slippage, or the area that I wanted to put my stop loss, it was deviating. It wasn't exactly 500. It was like maybe 400 plus, or maybe sometimes it was like 520. So the R multiple isn't 100% accurate, which doesn't accurately tell me how much risk reward am I actually pulling out. Because you can see ever since I went into drawdown, right? Ever since I went to that drawdown in September, I was actually gradually decreasing my risk. I was gradually decreasing my risk from $500 per trade to 4 to 300 to 250 and then even 200. So I actually lowered my risk to more than half. I lowered it by more than half. And then, yeah, I only made 2.96% in December, which makes you think, oh, I only made like what, 6R? But no, I was risking 0.2 to 0.25% for the whole October, November, December. And I pulled 4% within that period, which is almost 16R. So you have to realize, or like kind of see the nuance in your progress, in your results. Because there's no point looking at this number as saying, oh, I didn't do anything, I didn't make anything. No. I controlled my drawdown, I lowered my risk, and I recovered, and I made 16, if not more, risk reward during this period. It's something to realize and be proud of, right? Because on paper, it might not seem like much, but it's important to tell yourself and remind yourself that you are progressing, even if the equity curve says otherwise. Because why do you want to beat yourself up? There's almost nobody else that believes in you to be a profitable trader. You only have yourself. You only have your own self to tell yourself and to prove to yourself that you are consistently profitable and you can actually make trading work. No one else is going to do it for you. So it's even more important that you don't bash yourself up for not being profitable. Bro, there's people that are struggling to be profitable after 10 years of trading. Maybe because they fucked up somewhere, or their environment, or the responsibilities externally, yada yada yada. But you have to fight for it. You have to fight for yourself and tell yourself that you can do this. But of course, you have to be realistic at the same time. You have to figure out where, okay, I'm unprofitable, but where, when, which day, which pair, which time. And that's how you improve. Right? Type shit. So, yeah. Hopefully this video is a reminder, if you're trying to be a trader, if you want to be a trader, if you want to be a profitable, consistent trader, you have to put in the work. And the work is not drawing lines on the chart. It's not finding the magical indicator or signal or mentor. No. It's finding the edge in your trading data. Which means you have to take trades. Which means you have to not be fearful. You have to push yourself to take trades when there's an opportunity and be absolutely fearless, right, in your trades. Because, the last thing you want is to be a fearful trader and scared of taking trades or scared to lose money, and you ended up not taking any trades and not seeing where are your weaknesses, right? Because the last thing is to not be able to see your weakness, and then you become blindsided, right? You don't see your blind spots, and then you fuck up. But you fuck up worse, way worse, right? So yeah, you have to put in the work, not just to journal your trades, but to seriously, accurately detail every single thing about your trades. So you can see, like, for my spreadsheet for next year, for 2026, I'm gonna track not just the date, the day, but also, right, the direction, the lot size, the amount that I risk per trade, right? And then find the R multiple, and then, also the open, the close, the duration, the entry hour, the session, and then also now I'm gonna be including my entry criterias so that I can see which higher time frame POI is the most profitable, and which liquidity sweep, which kind of market structure shift, which entry model, and which take profit target is the most profitable. And then with all those variables, you can use pivot tables and find out exactly which time, which entry model will be the most profitable. And that's how you actually refine your edge, right? I mean, I'm quite surprised that not a lot of people talk about this, because everybody is talking about psychology, or finding a better indicator, or strategy, ICT, SMC, silver bullet, or I don't know what shit. Like, it's all the same. A strategy is a strategy. An edge is an edge. It's all just a blank canvas. Whether it's ICT, whether it's, I don't know what, pivot points or whatever indicator that you use, it's all a blank canvas. It's not an edge. The edge is actually looking at the data, tracking your data, and finding out where is your edge, right? Then that's where your actually profitable strategy comes from. It comes from this. Comes from all of this. It doesn't come from what, like, yeah, so what if I use an ICT power of 3 quarterly theory, da 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 da. Yeah, sure. It's a strategy. It's profitable. I can teach people how to use my strategy, how to trade my strategy, but they won't have the same results. They won't be able to see all of this and adjust accordingly and become increasingly, a better trader, to prevent edge decay, right? Because edge decay is a real thing. Eventually, in a long enough time frame, my edge will decay. I will become less profitable in the long run, and I need to find out how to mitigate that. How do I negate the edge decay, right? By avoiding all these losing days and losing times, losing sessions, right? So yeah, hope I didn't go off on a tangent again, but I mean, I hope this video kind of shed some light into what it's like to actually be a trader and what you actually do. Because people think that trading is just, oh, just look at the screen chart, monitoring the price action, da 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 da. No, that's just like 30% of the work as a trader. The 70% is actually figuring out yourself, your behaviors, your patterns, your thought process, and figuring out ways to improve on that. Which is, I guess you can say, it's qualitative. It's not like, oh, like if A is B, then C, like, yeah. But at the same time, it can be, if you tracked your data quantitatively, in a quantitative manner, you can see results. You can see actionable steps that are, I guess you can say, qualitative in nature, that will help you progress and become a better trader, right? So yeah, this video is, I don't know, it's my first video to make on YouTube. I don't really know what to say. If you found it useful, like, share, subscribe. I don't really care. I'm just here to kind of document my journey of being a trader, of being a consistently profitable trader, of scaling up to 500k capital by 2026, hopefully a million by the following year. But yeah, I mean, to be honest, I guess I kind of surpassed my expectations, because I was kind of like just working on passing my damn account. I didn't expect to get funded so quickly. I mean, I literally passed phase 1 and phase 2 in August, in 1 month, after suffering for 1-2 years. I passed it all in 1 month. It just came out of nowhere. It just so happened that I was taking my winning trades as per usual, but the frequency of the winning trades was a lot in August. And then when I look back at the price action for August, right, it was pretty much just a consolidation. If I look at August price action, right, August price action right here, it was pretty much consolidation. And I was the most profitable during this consolidation period when everybody was complaining that August is the worst trading period. So it just shows you how different people's strategy is different, in a way. So yeah, I think it's like a 50-minute video already, so it's very long, but I hope you guys found some value out of it and see the importance of actually tracking your data properly instead of just like, tracking, which pair I trade, what was my risk reward, what was my direction, long or short, that's it. Like, no, you have to quantitatively track your data, everything, just to see where your edge is, right? It's not easy to find, right? I had to do all of this shit on my own, manually, without any help, and slowly find the gaps, find the opportunities for me to correct and improve, right? Which are all here. To some people, it's just a random bunch of numbers, but to me, it tells me exactly where my winning trades are, where the needle is in the haystack. But you can't do this, without taking trades lah, and not being scared to take trades, not being scared to take the risk, and trying to find improvements. So yeah. Okay, I'm rambling on too much. Thank you for watching my video. I appreciate it very much. If somehow miraculously you got all the way to the end of the video, I owe you a big one. Honestly, I didn't expect anybody to watch all the way to the end. I appreciate you very much, and I'll hopefully see you in the next video. When I get my payout. Please, I need to get my payout, bro. Say real shit pissing me off. Alright, see ya, bye bye.